Welcome to our lecture on IAS 28. Before we look at IAS 28, let's just quickly revise where are we currently with our different types of investments. Now, when you look at our basic example, we might have a parent company that purchased shares in a subsidiary. Now, when will this be a subsidiary? When we are able to identify that there is control in terms of IFRS 10. If we've determined that there is control, we know we need to consolidate in terms of IFRS 10, and we need to apply the acquisition method in terms of IFRS 3. Right, now in the separate records of our parent, remember the separate annual financial statements, our parent will apply IAS 27 paragraph 10A. Now, if we look at a scenario where we have an investor that purchase shares and this is an associate, we will have to determine that there is significant interest in terms of IAS 28. Now this can either be less than 20% or more than 20%. And then in terms of our group, we will have to equity method accounting. I'm going to explain this to you just now. Now, if we look at IAS 27 paragraph 10, you will remember that we have identified that the investment in the separate records of the parent or investor should be at cost. Therefore, in the separate records, our parent and investor in their financial statements will debit the investment in subsidiary at cost. And let's say, for example, purchased cash, credit, bank. And when we apply IFRS 3, there might be identifiable assets and liabilities, and we need to identify that all assets and liabilities should be included at fair value. Therefore, there might be a fair value adjustment. Remember, this section here will be in terms of our group principles. But in the separate records, remember, at cost. When you look at your IAS 28 notes, first we will have a look at what is a joint control or significant influence. Once we've determined this, we need to look at the accounting in terms of our group, and then we will move on to our disclosure in terms of IFRS 12. Let's first have a look at what is significant influence. I want you to please open your IAS 28 paragraph 5 to 9. Read through this, stop the video, read through this, and then you continue watching. Right, by now you should have already included your flag to easily open IAS 28. Now my suggestion, when you look at the right side of my screen, I will include another flag to indicate to myself that this is the significant influence section in terms of a theory question. Therefore, when I receive a theory question, immediately I'm able to open here, and you will identify all of my keywords. I have included red sections for you to be able to identify. Now, I assume that you have already read through the paragraphs, therefore I'm going to explain them to you. Now, if you look at paragraph 5, paragraph 5 indicates to us, if an entity holds directly or indirectly 20% or more of the voting power, our keyword, we may assume that that entity has significant influence unless demonstrated not to. Or if that an entity has less than 20% voting power, we may assume that that entity does not have significant influence unless we are able to identify, clearly demonstrate this is not the case. Therefore, 20% or more voting power, yes, significant influence. Less than 20% voting power, no, not significant influence unless. Now, when we look at the unless, the existence of significant influence, a keyword, by an entity is usually evidenced in one or more of the following ways. If there is a representation on the board of directors or equivalent governing body of the investee, remember, think about voting power. Do they have the power to vote on the board? B, participation in policy-making processes. This is also an important one in terms of our financial and operating policies. C, material transactions between the entity and its investee. May they participate in decisions in terms of material transactions? Interchange of material personnel between entities, and then provision of essential technical information. Now you will have to read a scenario to be able to apply these sections. Now when we look at paragraph 7, it indicates to us, if we take this one step back, if we have an investee that owns any share warrants, share call options, debt or equity instruments that can be convertible into ordinary shares that have the potential, if exercised or converted, to give the entity additional voting power. Important. Therefore, if we take this one step back, the investee has a possible, let's say here, option which can be converted into ordinary shares, which will provide it with voting power over the company. In terms of the financial and operating policies, we can take this into account only when it is currently now convertible. Now, what does this mean? If our entity has options, currently we are standing here. Let's say it's 1 January 2022. And our entity has these options to be able to convert into ordinary shares. But the agreement states that these options can only be converted 2023. It's not currently convertible. Therefore, we may not take this into account to determine the voting power. Right, now your keyword, voting power, financial and operating policies. You will have to read a scenario very carefully. Okay. Take into account all facts and circumstances, and then it indicates to us in paragraph 9, an entity can lose significant influence when it loses the power to participate. Now, I just quickly want to mention something. You need to know that power, in this case, remember, does not mean control. This is very important. Power does not mean control. Indicators is your IAS 28, paragraph 6. Power does not mean control. If you look at the definition of control in terms of IFRS 10 on the left side of your screen, remember this will be when the entity has power plus the exposure to variable returns plus the ability to use the power to affect those returns. Significant influence, they have the power to participate in financial and operating decisions. They will not be receiving any dividends based on these decisions. Okay. Now, if we look at significant influence and we are able to identify that an entity has significant influence over another entity. For example, A has significant influence over B. B will be an associate and we need to apply IAS 28. Right. Now let's just quickly have a look at joint control. You will cover this in detail when we look at IFRS 11. The investor with joint control over the investee has entered into contractually, look at this, there has to be a contract, agreed sharing of control over an arrangement. Only exists when the decisions about relevant activities, keyword, require the anonymous consent of parties sharing control. If they need to make decisions, both entities, entity A and C owns shares in entity B, but they've entered into a contract where both has to participate in the decisions, and this we will call a joint venture. Now, a joint venture will also follow the accounting of IAS 28. The parties have the right to the net assets of this arrangement. Let's move on to how to account for an associate or joint venture in our group. Now, if we take this one step back, very basic example as always, on the right side, we have our investor, company ABC Limited, purchase shares in P Limited, and we have identified that there is significant influence, therefore this is an associate and we need to apply our equity method accounting. In the separate records of P Limited, remember in terms of IAS 27, paragraph 10, at cost. Therefore, in the annual financial statements of ABC Limited, we will debit the investment in associate, let's say cost 88,000 and purchased cash, credit bank. Right. Now, if we look at equity method accounting, I want you to please open IAS 28, paragraph 10 to 19. Highlight the keywords that I have included in the notes only. Remember, it's not a coloring in competition. Your standard should work for you. I'm going to make use of the notes to work through the principles. In our group, equity method accounting, step 1, include the asset at cost initially. Remember, initially is on the date when they enter into this transaction or purchase the shares. Number 2, any retained earnings or loss or profit or loss of your current year should be recognized as share of the investee. I'm going to look at journals just now. Let's first work through the theory. Number 3, distributions received will reduce the carrying amount of the investment. Therefore, this will be your dividends. Number 4, recognize the share of any OCI of investment. Right. Now, when you look at this, initially at cost, do you see that this is the exact same journal as per IAS 27 paragraph 10? Therefore, from a group perspective, this will already be included. Okay. Now, if we look at these principles, I want to apply this to my timeline as well as my analysis of owner's equity. If you look at the analysis of owner's equity, P Limited, 40% own. Therefore, ABC Limited owns 40% of P. Now, again, it's your choice if you want to make use of an analysis of owner's equity or not. My recommendation, you don't have to draft the table, but when you do the calculations, do this in the format of your table by including your total and your percentage. I will always just include my percentage, not really split them into the two, right? Now, I divide my analysis of owner's equity into the at acquisition, since which will include my retained earnings, and I prefer to have my current year separately. Therefore, my at acquisition will be in terms of my step number 1. It should be included at cost. My since will be my step number 2 as well as my current year. Therefore, I will have to obtain my total retained earnings, times this by 40%, 24,000. My total profit for the year, 50,000, times by 40%, 20,000. Therefore, if you look at my journals on the right side, remember our first journal is already included in the separate financial statements of ABC Limited. Now, my second step of journals, we debit the investment in our group. Remember, this is now in terms of our group, we equity method. We debit the investment, therefore our asset value will increase. We credit our retained earnings with a portion relating to our retained earnings, 24,000. And we credit our share of profit of associate with the 20,000. Therefore, the profit of associate, if you think about this portion our group will receive. Income increase on the credit side, therefore increase. And then in terms of our step number 3, if there's any distributions, which will be our dividends, this will decrease our investment in associate. Eliminate your intra-group transaction. We will have to debit our dividends income from group point of view, therefore decrease in income, debit. And we will have to credit the investment in associate. It's an asset, therefore decrease on the credit side. Right. Now, if you look at the equity method in terms of your timeline at the top, you will identify that my at acquisition section, this portion here will be my retained earnings, and this portion here will be my profit and loss, and then my dividends. Therefore, very similar. Therefore, if you have a look at an analysis of owner's equity compared to a timeline, if it's easier for you to draft your details on a timeline but still know your principles, you are more than welcome to do this. Okay. Now, if we look at the right side, please remember I've indicated to you in the separate records of our investor, ABC Limited. ABC Limited recognized at cost. Now, if we look at the separate records, the annual financial statements of P Limited only, and we look at the net asset value, assets minus liability equals equity. And the total is 320,000. 320,000. You use that 320,000 and you times this by 40%. You will be able to obtain the value which should be included in our group. 128,000. Therefore, in your group financials, you will have a line item called investment in associates to the value of 128,000. And in the profit and loss of your group, remember, you will have a line item, share of profit of associate. Right. Therefore, the basic principle is that you need to include the percentage of the net asset value of the associate into the group. Right. Now, what will happen if the cost exceeds the share of net assets, or if the cost is less than the share of net assets of the associate? If the cost exceeds, let's say 88,000, the net asset value, only the portion that should be allocated to the group, in this scenario, 40%, and the net asset value is 40%, the net asset value of 40% is 60,000. The cost will be 28,000 more. Therefore, goodwill is included in the purchase price. Now, it is important you do not recognize goodwill separately. What does this mean? If you think about IFRS 10, remember your consolidation, your at acquisition journal, you will debit your share capital, retained earnings. You will credit the investment to ensure that there is no double counting, take it out. And if there's goodwill, you debit goodwill. Therefore, there will be a separate line item indicating that there's goodwill in terms of this transaction. In terms of an associate, you do not include this journal. There will not be such a journal where we include our goodwill, right? But if it is that our cost is less than the net asset value, 70,000, and the net asset value of the portion interest in the associate is, for example, 100,000, there will be a 30,000 in terms of our group. Think about this. Why? We've included the 70,000, which comes from the separate records, but now there's still 30,000 additional in terms of the net asset value. We will have to debit the investment in associate, this will increase, and credit gain on bargain purchase in your profit and loss. Or if this happened prior years, identify retained earnings. Right. Now, there's 3 additional sections that I want to work through. Number one, when there is fair value adjustments at acquisition date, when there's possible impairments of the associate, or when the associate recognized a loss in terms of profit and loss, which should be included in the group.